diluted earnings per share. Now, in this case, when talk about diluted earnings per share, we say that this is the earning per share which is computed by the company taking into account the effect of the potential ordinary shares on both the earnings or the profit which is attributable to ordinary shareholders and also to the weighted average number of shares. So mean that this is an earning per share which is computed, or we say it is computed taking into account or taking into account the effect, taking into account the effect of potential ordinary shares, ordinary shares, both on the profit or both to the profit, and one-offs Now, in this case here, we have the term potential ordinary shares. Now, when talk about potential ordinary shares here, we say that this refers now to any contract or basically any financial instrument issued by the company, which then requires the company to issue ordinary shares in what? In future. Meaning that when talk about now the potential ordinary shares, ordinary shares, we have said that this is a financial instrument. This is a financial instrument, stroke contract, which abridge, or which requires, that is, which requires the company to issue ordinary shares in future, shares in what? In future. And therefore, when good examples of this particular potential ordinary shares, or basically examples will include one, we do have what we refer as the convertible securities, or what in other terms we refer to as a convertible financial instrument. And two, we do have what we refer as a employees stock options, stroke warrant. So these are basically good examples of what we refer as potential ordinary shares. Now, first of all, when talk about what we refer as convertible securities, this include those particular financial instruments which will actually confer or basically give their holders the right to convert them into ordinary shares. And therefore, good examples of convertible securities include convertible debentures, convertible preference shares, convertible bonds, convertible own stock, and so on, simply because the holder of those particular financial instruments or those particular securities do have the right to convert them into ordinary shares. Now, the other good example of potential ordinary shares is employee stock option, or basically stock warrant. I think we mentioned something to do with that in our previous class when we were looking at the computation of basic earnings per share, and we say that employee stock option or warrant are basically the rights given to the employees of the company to buy shares of the company in future at a price which is below the market price. Now, what you need to note is that employee stock option or basically warrant will only be considered now to be a stock option if the employees have not exercised their option as at the end of the year. So therefore, what we have said is that when computing now the diluted earning per share, what we do is that we take into account the effect of those particular potential ordinary shares on both the profit, and it is now the profit which is attributable to ordinary shareholders, and also what we refer as a one-offs. For instance, if at all maybe we are told that a company, maybe you can just have a small illustration to understand how we compute this. If we are told that a company had issued maybe like 8% convertible, 8% convertible debentures, having a value of maybe shillings 10 million. Now what you need to note is that in each and every financial year, this company which has issued this particular convertible debentures, the company will be required now to pay interest, will be required to pay interest to the holder of those particular what? Debentures. So what you need to note is that that particular interest which is paid by the company, by the end of the day, this is an expense. This is an expense in the income statement. So mean that by the end of the day, when computing this profit or the earnings which will be attributable to ordinary shareholders, that interest will have been deducted. Two, as a result of the company having issued those particular convertible debentures, the holders of those debentures will be having the right to convert them into ordinary shares, meaning that the moment now the holder of these particular debentures decide now to exercise their right and they convert them into ordinary shares of the company, shares of the company, that will be having two effects. One, that conversion of the convertible debentures into ordinary shares, one, it will be affecting the profit of the company, because once now those particular debentures are converted into ordinary shares, the company will stop paying that what? Interest. And therefore, the amount of profit here or the amount of earnings attributable to ordinary shareholders will have now to increase simply because the company will no longer pay that interest. Two, the number of ordinary shares issued by the company, number of ordinary shares issued by the company still will increase, meaning that if the number of ordinary shares issued by the company will increase, then there will be an increase in what? Warrants. And that's why we have said when computing now the diluted earning per share, we take into account the effect of those particular potential ordinary shares, both on the earnings or the profit and also on the number of ordinary shares. And therefore, for the purpose of computing this diluted earning per share, there is an assumption which we make. For instance, if we are told that in a given financial year the company had issued 8% convertible debentures, we compute now the amount by which the profit would have increased by during the current financial year if those particular debentures were converted into ordinary shares in course of the year. So mean that we compute something known as increase in earnings. Two, we also compute something known as increase in number of shares. But for us now to be able to do that, then there is an assumption which we make. The assumption is that if the company has issued convertible debentures, then those debentures were converted into ordinary shares in course of the year, meaning that this profit will increase with a certain amount, and then the number of weighted average number of ordinary shares would have increased with a certain amount. And therefore, when computing the diluted earning per share, this is the formula which we use. We use now the earnings used in the computation of basic earning per share. We have to remember that the earnings or the profit used in the computation of basic earning per share is given by the profit after tax less the preferred what? Dividends. And then to this we add something known as increase in earnings. So basically you have said that increase in earnings refers now to the amount by which the profit of the current financial year would have increased by if, for example, these convertible debentures were converted into ordinary shares, because we have said if that is the case, debentures were converted into ordinary shares, the company would not have paid that interest, meaning that our profit then would have increased with a certain amount, and then we divide that with the weighted average number of shares still used in the computation of basic earning per share, and then to this we add increase in number of shares, increase in number of shares. Now, in this case, when we talk about increase in number of shares there, we are talking of the number of ordinary shares, which, for instance, would have been issued by the company in course of the year on the assumption that these convertible debentures were converted into ordinary shares in course of the year. So therefore, generally, that's now how we compute now the basic earning per share. Before we look on a specific illustration in terms of the computation of basic earning per share, I want us to look on how we treat the convertible securities and the employees stock option for the purpose of computing our diluted earning per share. And let's start with the convertible securities. Convertible securities. Convertible securities. Now, first of all, we have said convertible securities are the financial instruments which confer the holders the right to be able to convert them into ordinary shares. And basically, I've said that good examples of this, include convertible debentures, convertible bonds, convertible loan stock, and convertible preference shares. Remember, preference shares, we said in other terms, these can also be referred to as preferred shares. So therefore, these are good examples of convertible securities. They confer their holders the right to be able to convert them into ordinary shares. Now, if at all you are told that, or if you are given a question and we are required to compute the diluted earning per share, the first thing we are supposed to do is to identify the potential ordinary share. And maybe let us assume in our case, we are given a case whereby a company had issued, maybe the company had issued convertible securities, e.g. convertible debentures, convertible loan stock, and so on. So for the purpose of computing the diluted earning per share, then you have said that we make an assumption that those particular debentures, that is convertible debentures, convertible bonds, convertible loan stock, were converted into ordinary shares in course of the year. So as a result of that, then we have said that the earnings which is attributable to ordinary shareholders as used in the computation of basic EPS would have increased with a certain amount, and also the number of shares would have increased with a certain amount. Now, having made that particular assumption, we are supposed then to compute. We are supposed to compute two items. One, we should compute something known as increase in earnings. Increase in earnings. What now we have there in our formula. Now, this particular increase in earnings is computed as, in case the company has issued convertible securities whereby the company is supposed to pay interest, e.g. debentures, bonds, or loan stock, the increase in earnings is always equal to the amount of interest which was paid by the company during that year, but this interest should be taken net of tax. What we have to remember in taxation is that interest on debentures, interest on both interest on loan stock, that interest is allowable expense. So therefore, it is always deducted before tax. So that's why the amount by which earnings would have, or the amount by which the profit would have increased by, should be equal to that interest, but it should be net of tax. It should be net of tax simply because that is tax allowable. But on the other hand, if at all maybe the company has issued or had issued convertible preference or preferred shares, the amount of increase in earnings is always equal to the preference dividend for the year, preference dividend for the year. So therefore, that is the first thing we are supposed to compute, that is increase in earnings. But we have said for us to compute that, we have to make an assumption that these convertible securities were converted into ordinary shares in course of the year, because if they were converted into ordinary shares in course of the year, the company would not have paid interest, meaning that our profit would have increased with that amount of interest net of tax. If the company had issued convertible securities, the amount of earnings or the amount of profit would have increased with the amount of preference dividends paid. After computing that, two, we proceed and we compute what is known as increase in number of shares. increase in number of shares. Now, in this case, when we talk about increase in number of shares, we are talking of the number of ordinary shares which would have been issued if at all those particular convertible bonds or maybe convertible securities were converted into ordinary shares in course of their definitely. For us to compute that, we will compute that using a certain rate we shall be given. So therefore, you'll be told that for each maybe convertible debentures or both having a certain value are convertible into to certain number of ordinary shares. Now, having that, then we need to proceed and we compute now the increase in earnings. Now, having computed these two values there, increase in earnings, increase in number of shares, then we need to apply that formula and then we compute the diluted earning per share. So that's generally how we deal with what we refer as the convertible securities. Then on the other hand, we have said that the potential ordinary shares will include what we refer as employees options, that is stock options, options and warrants, of which we have said that these stock options and warrants are basically now the right given to the employees of the company to buy the shares of the company in future at a price which is below the market price. Now, first of all, we say that for the purpose of computing the basic earning per share, if you can be able to remember the basic earning per share, we say that we use stock options and warrants whenever the employees have exercised their right in course of the year. So that is when we use the stock option and warrant. And basically we say that whenever now the employees exercise their option, they buy the shares of the company at a price below the market price. And therefore, those shares which are issued to the employees once they exercise their stock option, for the purpose of computing the basic earning per share, we say that we split them into two components, into shares deemed to be issued at full market price and what we refer as the bonus element, or basically those shares which are deemed to be issued for free. But on the other hand, for the purpose of computing now our diluted earning per share, stock options and warrants will only be considered to be potential ordinary shares if the employees have not exercised their right as at the end of the year. Because if the employees have not exercised their right as at the end of the year, then they will be buying the shares of the company in future. So therefore, that is very, very important that stock options are considered as potential ordinary shares, shares if they are not exercised, that is important, if they are not exercised at the end of the year, year. So mean that if now the employees have not exercised their stock option at the end of the year, definitely they will be having a right to buy the shares of the company in future at a price which is below the market price. Now, if that is the case, then still we need to compute these two items. We need to compute one, increase in earnings, and what we have said is that stock option stroke warrant are basically the right given to the employees of the company to buy shares of the company in future. And therefore, what you need to note is that unlike these convertible securities, which are still potential ordinary shares, these rights given to the employees of the company do not have any effect on the profit for the year, because you have said something like debentures, they have effect or they reduces the profit of the year simply because the company paid interest. But once the company has granted the employees the right to buy shares in future, that right do not have any effect on the earnings or the profit for the current year. And therefore, in case of stock option, we say that the increase in earnings is always equal to 0. That should be the case. 2, we also compute increase in number of shares, Now, to compute this increase in number of shares, just like what you have said in case of convertible securities, we then make an assumption that the employees exercised their stock option in course of the year. If they exercise their stock option in course of the year, then those shares which would have been issued by the company would have been split into two: shares which were issued at full market price and shares which were issued for free, or the bonus what? The bonus element. And therefore, in this case here, when computing now this increase in number of shares, those shares which would have been issued by the company, assuming the employees exercise their option in course of the year, would have been split into two. Those shares which were issued at full market price, and those shares which were issued for free, or basically what we refer as the bonus element. Now, these shares which would have been issued at full market price, these shares will not be having any dilution at all, or will not dilute the basic earning per share, simply because these are shares issued by the company, and the company receive additional resources or receive additional amount of money. So therefore, these particular shares here do not have dilution, or basically they do not reduce earning per share, and therefore for the purpose of computing the basic the diluted earning per share, those shares are never considered. But on the other hand, we do have the bonus element, and basically these are shares then which are deemed to be issued for free. So these are the shares which will be issued by the company, or the company here will issue additional shares to receiving additional resources, just like a case whereby from our profit here, from our here computing basic earning per share, if you increase the number of shares issued by the company, that is never affected, or you don't affect the profit, then the basic earning per share which you compute by the end of the day there should be less, because you have increased your denominator, your numerator remained the same. So therefore, we have said in case of the bonus element here, these are additional shares issued by the company, but without the company receiving additional resources. So therefore, that basically how we treat convertible securities and the stock options, basically when computing the diluted earning per share.